An accelerated death benefit is a rider on your own life insurance policy that pays you part of your own death benefit early, in cash, if you become seriously ill. The money comes from your insurance company, not from a buyer. There is no sale, and every dollar you take comes out of what your family receives later. If you are thinking about selling a policy, this is the first thing to check, because you may already own one of these riders and not know it. It is also widely misunderstood because what you receive and what your family gives up are two different numbers. Here's what triggers it, how much it actually pays, what it really costs, and when selling does better. Riders vary, but the triggers come from a common regulatory model. The main one is terminal illness, certified by a physician. Your contract sets the line, and under the uniform standards these riders are filed under, it has to fall somewhere between 6 months and 24 months of life expectancy. Others pay on a condition that requires extraordinary medical intervention, like a major organ transplant or continuous life support, or on permanent confinement to a nursing home. Many newer policies add a chronic illness trigger, meaning a permanent inability to perform at least 2 of the 6 activities of daily living, or permanent severe cognitive impairment. One detail people miss: a rider can make you wait after the policy takes effect, but that wait cannot run longer than 30 days for an illness. Less than most people expect for 3 reasons. First, the cap. Your contract sets the most you can accelerate, usually a share of the death benefit with a dollar ceiling on top, and it is rarely the whole policy. Second, the discount. The model regulation lets the insurer pay you the present value of the amount accelerated, which is a reduction for paying you early. Third, the lien. Instead of discounting, the insurer can treat the payment as a lien against the death benefit and charge interest on it. Under a lien, the administrative charge, your future premiums, and the accrued interest all attach to that lien, so the amount deducted from the death benefit keeps growing after your check clears. 2 things the rules do protect. You have to be offered a lump sum, and no one can restrict how you spend it. 3 costs sit outside the payment itself. Taxes. For a certified terminal illness, an accelerated benefit is generally free of federal income tax under Internal Revenue Code, Section 101 CEG. For chronic illness, the exclusion is narrower, with a daily dollar limit set each year by the IRS, and payments above it can be taxable. Confirm your own situation with a tax professional. Benefits. Insurers are required to warn you that an accelerated benefit may affect your eligibility for Medicaid or other government programs because a lump sum sitting in your bank account is a countable asset the day it lands. And premiums. Accelerating does not always stop the premium bill on the coverage you have left. Ask what you still owe and get the reduced death benefit in writing before you sign anything. Check the rider first. If it covers what you need, it is faster, nobody shops your medical records, and the policy stays yours. But get the second number before you decide. If a physician has certified a life expectancy under 2 years, the same illness that unlocks the rider also makes the whole policy worth the most it will ever be worth to a buyer. In those short life expectancy cases, strong ones price at 50 to 80% of the face amount, which is often more than a capped and discounted rider advance. Order matters too. An unpaid lien travels with the policy, so accelerating first lowers what a buyer would pay for it later. Ask your insurer what the rider would advance and what would be left, then find out what the whole policy is worth on the open market, and compare the two before you take either one. Citizens Life Group put this explainer together. If you want a number for your own policy, the estimate link is in the description. There is no upfront cost. There is